EPR stock presented earnings last week, so it is the perfect time to see where the company is at. And more importantly, is EPR in the buying range? And one of the main reasons why people like EPR is obviously their amazing dividend, currently yielding at 7.6%. And the interesting part is they pay a monthly dividend. The downside for most people is that EPR had a negative 20% return in the past 5 years, while the S&P 500 had a 100% return. That is a pretty big difference if you ask me. And keep in mind, this is including the juicy dividend. So let's check the recent earnings report, do a fundamental analysis, and finally create the 3 price targets. On the 30th of October, EPR presented their earnings, where they beat on FFO and revenue with a slim margin. However, the stock went down about 6% after earnings were released, and that's pretty odd after the recent bull run in the REIT sector. Looking at the total revenue for the third quarter, we see that EPR reported 180 million, down 5% year over year. And to make things even worse, net income was reported at 40 million, down about 19% year over year. AFFO and FFO are down 11 and 12% respectively. But still, I don't like to see these numbers to go down way faster than the total revenue. So this is a concern to me. But lucky for us, there's also good news. The net debt to EBITDA is reported at 5 times, which is in the range that I prefer. On top of that, the AFFO payout ratio is at 66%, so the dividends are covered very easily. For the full year of 2024, they narrowed their FFO per share guidance a bit. Nothing too crazy, I think. And it's the same story with the other numbers. Looking at the historical trend in leisure spending, we see that this is actually going up at a pretty high and consistent pace. Of course, there is a small slowdown in the recession periods, especially the most recent one with COVID. But this shows that the industry is really an interesting niche. Looking at the specific EPR portfolio, we see that 93% of the properties is experimental focused, of which theaters is the biggest sub-segment with 36%, which is quite a lot. Eat and play is the second biggest with 24%. Looking at the rent coverage, we see that theater actually at a pretty low rate of 1.5 times, while the non-theater coverage is at a much healthier range of 2.6. And the interesting part is that for the theater segment, they are planning to reduce this sub-segment, and the same goes for the education portfolio. Diving a bit more in the theater segment, we see that this is recovering ever since the lockdown periods, but it is still not at their all-time high. So in my opinion, it is a good thing that they are reducing this segment, since this segment never fully recovered. The other sub-segments are focusing on growth, which is great. The occupancy rate are looking pretty good at 99%, so this comforts me a lot, especially in this specific industry. The same goes for the lease expirations. This is looking really good with an average of just 2% per year. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. EPR is a 3.5 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. And right now it is sitting at almost 9.8, indicating they could be undervalued. Later in this video I will show you my 3 price targets for EPR stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 636 million, and in this graph we see that revenue went up in the long run. But it has to be said, it has been a few interesting years now for EPR. During the lockdown periods they were hit hard, of which they recovered pretty quickly. But in the recent quarters, revenue kept on decreasing. So definitely keep an eye out on those numbers. Gross margins are down quite a decent amount versus pre-lockdown periods. Most recently, it is kinda stabilizing. The same goes for the operating margin and the net margin. I would love to see some increases here. The EBITDA margin, on the other hand, is increasing again, which is something that I really like. EPS is not looking that good, but for a REIT, it is not too bad for now. And for the upcoming years, it is not looking too exciting for the EPS growth according to the analysis expectations. For the revenue, it is looking very interesting as well, with low growth expectations and even a decrease at some point. Return on assets is sitting at 3.5%, which is a low number for a REIT. Return on equity is also looking pretty decent. And the most important number, return on invested capital, is sitting at nearly 5%, which is not too bad. It is slightly higher than the 5-year average, so that is very nice. Current ratio is at 1.29, which is a decent number for a REIT. Nothing special to mention here. And right now, EPR has 3 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. EPR has 35 million in total cash, so they can't pay down a big chunk of their debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down a lot over the years. So I prefer a bit more steady and pattern here. But at least it's going up, so that's the positive thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 7.6%, which is a great number. Annual payout is at $3.42 and payout ratio is around 70%, which is a little below the 75% average for REITs. And keep in mind, EPR pays a monthly dividend instead of a quarterly dividend. The 5-year growth rate is at a negative, but this is a bit diluting. During the lockdown periods, EPR drastically reduced their dividend payouts in order to survive. And being a leisure-focused REIT, it can't be blamed. After that, they increased their dividends again. In this graph, we see the expected dividends in 2024, 2025 and 2026. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at a slow rate from here. And overall, these dividends look pretty interesting to me. But how about the historical returns? I decided to compare EPR stock with the overall market, in this case the S&P 500. On the 5-year chart we see that EPR returns minus 20%, which is pretty sad to see. Also because the S&P 500 had a massive 102% return. And keep in mind this is including that juicy dividend. On the 1-year chart it looks a little better for EPR, with a nearly 11% return. However, it's the same story as with the 5-year chart. They got crushed by the S&P 500 with a 37% return. On the 6-month chart it is actually a pretty close call, with 14% return for EPR and a 15% return for the S&P 500. On the 1-month chart, it is unfortunately a negative again for EPR with minus 4%. The S&P 500 is kinda break even. So bottom line, the S&P 500 was by far the better investment in the past 5 years. And it looks like in the short run you were better off owning the S&P 500 as well. But could this be the perfect time to buy EPR stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 0, 2 and 4%. based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 30, 31 and 32%. For the free cash flow margin, I'm putting in 58, 59 and 60. For the PE ratio, I'm putting in 20, since it is a REIT. And for the price to free cash flow, I'm putting in 8, 9 and 10. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. And right now, EPR stock is around $46. I hit analyze, and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $33, we have a mid price target of $39, and we have a high price target of $47. And to me, the mid to high price target is the most justified here, indicating that this stock is kinda on the high side of this range. And please let me know the price target that you think is the most justified in the comments down below. My final conclusion on EPR is that I really love the industry focus. I also think that it is a really hard time to put a number on this company. Most valuation metrics are showing that the stock is undervalued. But if you factor in the current growth numbers, then it turns out to be at a fair valuation right now. And the thing is that I really don't like the current growth numbers. Revenue is decreasing for quite some time now, and they don't seem to have found the solution yet. On the other hand, the dividends are looking amazing. The yield itself is at a pretty high number, and they also pay a monthly dividend. Down the line, I think I will skip this stock, but I will definitely keep an eye on them since I would love to own this stock one day when they have found their way up again. So for now I will put them on the watch list and analyze them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.